let's talk about these results then. Tell us a little bit about them. It seems that some places where you've had some tough comparisons in previous years to go up against,
yes,
you know, that's showing in the results, isn't it?
I think there's two main stories in this. Just kind of go through. The first thing is we've grown by 7%, and that's in line with market estimates, so that's not a bad start to the day. It's our 11th consecutive quarter of growth. Significant acceleration of growth across the whole of Europe. That's worth talking about. We're up 16% in that market, and slowdown in growth in the UK to 1%. That's worth talking about as well.
I mean, if we're going to focus in around the world and we do that bit of a road trip, but I want to go to one of your big markets, Australia. It's your second biggest market. I'm just looking here. Growth of 1% in Asia Pacific, with Australia and New Zealand flat. Is that trend a worrying thing for us? This is one of your big generators. So
it's our third largest business. I would take flat at the moment. The positive is we've been sequentially stable for 9 months. If you think about it, what's interesting, if you take West Australia out of Australia's results, we're up 8% overall.
Because of the mining effect.
We've seen quite a strong comeback in construction property, in Sydney, in Melbourne, etc. Western Australia, mining, across the patch, impact on all activities there is down 38%. So 0 in a tough economy is not a bad position. And I'm very confident that our Australia business will return to growth within the next 6 months, but it's going to be relatively modest growth.
And you do describe that growth in continental Europe as excellent in the report, saying it's up 16%. It includes an acceleration of 14% in Germany. We were talking with Fitch on the credit side of things just a few minutes ago about the divergence we're seeing in different parts of Europe. Germany, on the one hand, our colleague Richard Jones from First Word has been talking about this a lot, and the slowness of France on the other. What variation do you see across Europe?
Uniformly strong growth. Why? Because we've had stability in the economy now for the last 2 years, after a very difficult path, not just the global slowdown in 2007-8, but also the Euro crisis. So we're the largest white-collar recruiter across Europe. We're the largest company by far in Germany. Our growth accelerated to 14%. Engineering, automotive increased. I would not have expected that 6 to 9 months ago for fairly obvious reasons. But let me take you to the positive. France, we're the second largest recruiter in France, we're up 16%. And the big trends are companies coming to us and saying, right, we don't necessarily want to take more permanent people, but can you get us high-skilled, high-paid professionals on a 6, 12, 18-month contract? So we've seen a big uplift in our contracting-type business there. So that flexibility of skilled labour has been a big selling point.
Let's talk about the UK. We got some pretty dire numbers yesterday out of the manufacturing, the industrial production here, and manufacturing numbers were very disappointing yesterday in the UK. George Osborne warns that 2016 there's a dangerous cocktail for the UK of new threats. Is that coming through? What's the confidence level of recruiters in the UK?
Well, let me give you 2 or 3 parts to that. It's been coming through since July. This is not a new story. I mean, one of the beauties of doing my job is we see this before any other business. We talked about the start of a slowdown in growth in the UK when we did our September results. Our growth has fallen from 14% to 6%. We had an exit rate of 4 then. We're 1 in here. Actually, the good news is there's no panic in the recruitment markets, but I think the further you go away from London, into the manufacturing heartland, into the SMEs, we've seen much more cautious from clients. And whilst it's great for George Osborne to talk about some toxic parts, this government has helped cause part of that. If you stand back and look at the increasing costs that UK PLC will face over the next 4 years, it's more than 15 billion worth of costs.
Can I ask you, is there a recession on the way in 2016?
No.
No recession.
No sign at all. You have public sector, which understandably is being much more cautious. They've all just had the new spending round. They've got some costs to do. Private sector, this feels like a pause for breath. Our private sector business still grow by 3%. We're across the whole of the UK. But there's a greater uncertainty. And all businesses look at the press, they watch your programme, and surprise, surprise, at the end of last year and coming into the start of this year, they're being a bit more cautious.
You're critical of government there, and some of the increase in cost is coming from staffing in the shape of minimum wage. You might be a little far removed from the minimum wage story, but is that what you're referring to? Because of minimum wage payments, they're recruiting less?
I do more than 50 breakfast seminars a year, so I go around the UK and abroad promoting our business and what an FD does. It's a nice link. I was in Manchester a few weeks ago. 8 FDs there, all in manufacturing. Every single one could say the incremental increase in cost to their business over the next 3 to 4 years. And all they're saying is, look, we now have to take this amount of cost out. Do we think we can increase prices? No. Sterling's gone against us, so we're being a bit more cautious. The real question mark for those businesses, in 2 or 3 months' time, will their forward order book start to pick up? If it does, this is all great, growth will accelerate, we'll accelerate. If it doesn't, we're in for slower growth this year.
Paul, talk to us about wages. The one thing the Bank of England is watching, the great productivity conundrum, schmumble, whatever it is. But wages are critically important. You're saying the balance there is get me more fixed-term contracts from the employer side. Where is that playing out in terms of the wages? Private sector pay for the 3 months to October dropped again, 2.3%. Give us a feed-through from employers. What are they prepared to pay? Where are the squeezes? And are there any wage pressures in the UK?
So there are always specific areas of wage pressures, and the two main ones at the moment is anything construction property related, where really the underlying wage level, certainly for skilled people, is 5% or above. You're in this beautiful period for high-skilled employees who've got a lot of experience in those companies. If they leave, there's lots of counter-offers. It makes our consultants cry because we lose the fee, but, you know, that is there.
Happy candidates.
I have to tell you, though, outside of construction property and parts of things like risk and compliance and data, etc., the wage pressures have started to reduce. Why? Because there's no inflation. And you know what? So employees have almost got to move or got to push to get a rise. And back to my earlier point, if a lot of companies are going to face a bit more increased cost, then, you know, a year ago I was talking about an increase to about 3% underlying wage inflation in the UK. I think now it'll be 2% at best.
Okay.
So I don't see that pressure.
We've talked about various parts of the world. Let's talk a little bit about China, both the specifics of the business there and how it's weighing. We talked so much about China since just the start of this year, and then in August last year with what they did to their currency. It was dominating headlines. Is this affecting your recruitment business there, and indeed just sentiment-wise, is it affecting other parts of the world?
So let me put into context first. In the UK, we've got more than 2,000 consultants. In China, we have 200. So our business in China has more exposure to Western companies, but it does have exposure into the manufacturing sector. So not just banking, it's IT and manufacturing. We grew by 13% in this quarter.
In China?
In China, on the back of a previous quarter where we had an all-time record. So at the moment, there is enough growth there. Across Asia, there's a little bit more cautious. It's mainly in the banking area at the moment. So we're seeing still good opportunities for growth. There's not the froth on the market that there was a year or so ago. It's still good for us today. I'm not sure any of the Western recruitment companies are big enough to be a good insight into that. But the intelligence we get from our clients is they still have big skill shortages. We're still moving people into China for our clients. There's still opportunities. So, again, I don't see a slowdown there. I think there are other parts in the world which are a bit more difficult at the moment.
I'm going to bring you back to the day job, which is about managing, you know, the risk within the business. Australia's a big business for you. You're an emerging market. You're in 33 countries. Currencies really are weighing in terms of a lot of people's performance. Are they going to weigh on Hayes numbers 2016?
I couldn't care less about currency. There's nothing we can do about
you don't
that.
Hedge. You won't hedge.
Finance director.
No, and it's not appropriate to hedge. Our shareholders know the mix of our business. We disclose every single quarter. It's on the second page what the impact of currency is. It's not our job to try to, you know, predict where the markets might go.
But it will hit your numbers. It will impact your numbers.
Of course it will. And we always disclose that. Yeah, and we've had benefits several years ago. We're getting a hit now. Who cares? All that really matters
Probably
is
the investors.
underlying fee growth. All the investors will compare how we're doing versus our competition, how we're doing in the markets, are we doing the right thing, are we growing the underlying business? And if we're doing that, they'll be happy with us. If they're not, they'll probably have me removed. So that's all we can focus on.